Good morning. Good morning, Sanjay. Good morning. Yeah. So we have largely completed all our Ind AS chapters. So today's session will deal with analysis of financial statements, and the one on Saturday we will be dealing with professional ethics. So largely the standard portion is over. So by now you would be expected to, for the time being at least, be able to identify and understand what would be the treatments. Of course, the finer points, as and when you revise, you should be able to recollect and provide your opinion or answers to the questions that will follow. Okay, so now when we talk about analysis of financial statements, so this broadly covers three sections. That is, first one is a theoretical part, that is characteristics of good financial statements. Then the best practices that would be followed when you prepare your financial statements. And we'll look at certain illustrations, which is basically a background of whatever you already are aware of in terms of Ind AS. Okay. So that will broadly be the outlook for today's session. It's going to be simple. None of the complications that we had earlier will be here, primarily because by now you would be having a fair understanding of how the Ind AS framework is and how these standards apply in the case of whatever issues that may follow. Okay. So now, when we talk about characteristics, when we talk about financial statements of corporate entities, that would be prepared in line with Schedule 3 to the Companies Act 2013. That I think you would be aware of. Okay. And then there are several disclosure requirements with respect to balance sheet and the statement of profit and loss. There are certain certain regulatory based entities like banks, insurance companies. For banks, it's the RBI. For insurance companies, it is IRDA. So these are the regulators who oversee these entities, and therefore the formats are prescribed by their entity regulators. So the banking, for the financials for the banks is prescribed under the Banking Act, whatever you have applicable. And for the insurance, whatever the IRDA has prescribed, that would come in as your financials. So when these are the companies which operate, the financials will be prepared as per those formats. And this is also recognized in the Companies Act 2013. Okay. Formats for these companies are prescribed by specific regulators. When we talk about format, it is a vertical format of balance sheet and does not provide the alternative of using the horizontal format. So vertical hona chahiye. Further, Schedule 3 sets out minimum requirements. Can you give something extra? You are most welcome. It allows line items, sub-line items, subtotals to be presented as an addition or substitution on the face of the financial statements. So, if you look at Schedule 3, it would be, for example, in the P&L, total income, total expenses to give you the PBT, and then the tax to give you the PAT, and then you have OCI. But many entities, for example, would be interested in knowing what is the EBITDA of the entity. They would be interested to know how the EBITDA is derived, what is considered, what is not considered. So you could introduce small subtotals. Okay. In fact, we are on the cusp of the introduction of one of the major financial statements, which will be a key driver of change in terms of preparation of financial statements. That is your Ind AS 118, which is expected to come in force from 1st April 2027 with comparatives from 1st April 2026. So that is going to bring about a great change in terms of preparation and presentation of financial statements. Ind AS 118. Okay. Is relevant to an understanding. Schedule 3 now requires all disclosures to be made as a part of the notes. Okay. Apart from granting an overriding status to the standards, cognizance has also been given to the requirements of standards in the format, and accordingly, elements such as deferred tax assets, intangible assets are included in the balance sheet. Okay. Also, it has been stated that disclosure requirements specified in part 1, 2, or 3 of the schedule are in addition to and not in substitution of the disclosure specified in the respective notified standards. So schedule 3 has given some disclosures. Those are over and above whatever disclosures are required to be given under the respective standards. So you have to look at the disclosures from both the perspectives. The terms used in Schedule 3 to be considered as per the respective notified standards. One of the pertinent aspects is that Schedule 3 does not prescribe the accounting treatment to be adopted. It is only talking about presentation, the format and the content. The fact that a particular item has been included in the format of the balance sheet does not imply that the particular item can be recognized. So Schedule 3 is only presentation. It is not about treatment, okay, which has been specifically acknowledged. Are we okay, Sanjay? Yes?
Yes, sir. Yeah. Okay.
All right. So this is general. This is something all of us are already aware of. Okay. Now, when we talk about good financial statements, what are the features of that? First one is true and fair view of the affairs of the enterprise. You have to give a true and fair view. So reliability factor is supreme. This is non-negotiable. Relevance. You should provide relevant information for the period it is presented. So you need not give past 10 years or 15 years data. All of that does not carry any significance. The key here is that the user of the financial statement should be in a position to take independent decisions after reading the financial statements. This decision can be different for different users. There may be an investor whether to hold the shares or whether you want to dispose them off. For a senior employee, it can be future growth prospects of the company, etc. Whatever it is. But key fact is users should be empowered to make the decisions through the financial statements. That is something that we have to recognize and understand. Understandability. For the user to make sense, the financial statement should be readable and content should be lucid to digest. Even a layman should be able to read the same. Well, a layman should be able to read the same, but tell me one thing. If it is a layman, will the complexities of Ind AS be extreme for him to understand? Or what do you feel for a layman?
Yes, it would not be easily understandable for.
It would not be easily understandable. Exactly. So while our efforts and endeavor will be to present it in something that even a layman can understand, we have to understand the fact that a layman will not necessarily understand everything that is mentioned in the financial statements. For example, actuarial valuation, what hits the OCI? Both of us know because we are literate in terms of Ind AS. But for a layman, what is actuarial assumption? What do you mean by OCI? All these things create a lot of complexities for a layman to understand. Okay. So that effort should be made to promote understandability, but we have to also recognize and appreciate the fact that the standards per se are complex in nature. So it's not an easy task always. Consistency, the users will be benefited only if statements are released in periodic intervals and in standard formats. Else, the entire purpose of furnishing the financials will be defeated. That is the reason that laws are prescribed for presentation formats and periodicity. Regulatory compliance. So, regulators, revenue authorities, all of them rely on the financials, and therefore it is something that we'll have to ensure. Universality, you should ensure that they should be comparable both within the industry and outside. Okay, so that is how you are ultimately going to evaluate. So good financial statements starting with true and fair, relevance, understandability, consistency, regulatory compliance, and universality. Okay, so all these things are some of the key characteristics of good financial statements. Are we okay with this? Yes.
Yes, yes.
It's nothing that is per se very complicated, whatever we are going to do today. Okay. All right. Now, best practices applicable to all companies as far as reporting is concerned. First one, you have to ensure compliance. Compliance means compliance to the Companies Act, compliance to the Ind AS standards. All these you will have to ensure. It is a regulated activity. Compliance with the requirements is a must. Comply with the standards, but also ensure your financial statements are an effective part of your wider communication with your stakeholders. Simple and understandable without any change in the interpretation. So this is on account of compliance. When we talk about complete, the information disclosed should be complete and not lead to any further cross questioning. So, for example, many times you see 2, 3 small notes that are put in. Inventory is as verified and confirmed by the management. That is not something you can put it. When inventory number is already there in the financials, it is an assertion that is already made by the management that inventory is worth X crore rupees. You don't have to put it separately, because the fact is, by putting it separately, it gives rise to another doubt that whether the auditor has actually performed the procedures or not. By writing it, inventory is as valued by the management, then it appears to signify that auditors have not done anything to confirm the existence, the valuation of this inventory. Yes or no? So therefore, you should not put in any of such sentences. Okay? Yes?
Yes.
Similarly, debtors creditors. What do you write? Debtors creditors are subject to reconciliation and confirmation. What are you signaling? You want to basically tell the reader that, look, I have debtors creditors in my books, but their balances are not confirmed. So reconciliation and confirmation is pending. But you tell me, is reconciliation from the counterparty statement uh, the only way of uh, concluding a balance? Yes. Is it the only way?
No.
No, you can perform alternative procedures. Nobody has stopped you. For example, for trade receivables, after the balance sheet date, look at the collections that have flown. Yes, look at the collections that have flown in, map it to the trade receivables, and that will give you confirmation that these trade receivables look genuine. Same for payables also. So you will have to look at for alternative methods rather than putting such points in disclosures and defeating the purpose of the financial statements. Okay, so that is on completeness. Okay, next is simple and specific. Be simple, be specific, avoid technical jargon as much as possible. Okay. Make policies clear and specific, no vague or ambitious notes, with no further information or explanation which may lead to misinterpretation of information. Okay, so that takes care of simple and specific. Next, transparency. Transparency. In preparation of financial statements, many times assumptions or other bases are taken. Disclose those assumptions and bases transparently. Are we okay with this?
Yes.
Yes. Yes. Transparency, then you move on to materiality. Okay. So that is obviously an all prevailing requirement. Which one? Materiality. Yes. So when you talk about materiality, material information is that which, in the absence of which, could probably give rise to another uh, decision that the reader of the financial statements could take. Are we okay with this? Yes.
Yes. Yes.
Okay. So you need to ensure materiality is preserved. Okay. A company in software sector has communicated to stakeholders a strategic intention to focus its new development efforts in cloud-based solutions. In a particular financial year, cloud-based revenues are less than 5% of the total but has grown rapidly. The company therefore decides to provide separate disclosure about its revenue stream in line with Ind AS 108, even though other revenue streams are typically combined into other revenue. Are we okay with this?
Yes.
Yes. Integration of notes. All your notes must be kept at one place. Okay. They are an effective tool of communication and have the greatest impact on effectiveness of the financial statements. Group notes into categories, place the most critical information more prominently or a combination of both. Integrate your main vote of a line item with its accounting policy and any relevant key estimates and judgments. Okay, so that is largely what about integration of notes. See, you would be having your balance sheet, P&L, cash flow, subschedules. Now, you will have to ensure that all the notes are put together in one place so that it becomes easy for us to read, understand, and get an idea of the financial statements. Are we okay with this?
Yes, sir.
Yes. बोलिए Sanjay.
Yes, yes. It's okay.
All clear. Okay. Fine. So you could be going through this for homework. Simple question here. Okay. Next, disclosure of material accounting policies. This is an adjustment that has come in. The financial statements should disclose your material accounting policies. What is your materiality that you have adopted? Disclose only those material accounting policies. Remove non-material disclosures that do not add any value. जो material है सिर्फ वही disclose करो. Do not disclose everything. Your disclosure should be relevant, specific to the company, and explain how are you applying your policies. Okay, so this is something you will have to give. Aim of the disclosures is to help your investors and other stakeholders to properly understand your financial statements. Use judgment to determine whether your accounting policies are material, considering not only materiality affected by the policy, but also other factors, including the nature of the company's operations. Are we okay with this? Yes?
Yes.
All right. Key estimates and judgments. For example, useful life of property, plant, and equipment. For example, provision for bad and doubtful debts. These are some of the estimates that you do. Effective disclosures about the most important estimates and judgments enable investors to understand your financial statement. So disclose that. Focus on the most difficult, subjective, and complex estimates. Include details of how estimate was derived, key assumptions involved, process for reviewing and an analysis of its sensitiveness. Provide sufficient background information on the judgment. Explain how the judgment was made and the conclusion that you reached. Are we okay with this?
Yes.
Yes. And
Yes.
now whatever is in vogue or what is in practice is integrated reporting. Yes, normally what you have today is not just the financial statements. You have the management discussion and analysis. You will be having secretarial report. You will be having CSR reviews. All these things will be there. Yes. So therefore, when you talk about an integrated set of financials, all these collated with the financials form part of your annual report. They form part of your annual report. Are we okay with this?
Yes.
Yes. So we are looking at data from various perspectives. It's not just the financials. Financials is just one step as far as data overview is concerned. Yes. That is only helping you to match the data. Yes. That is only helping you to match the data. Are we okay with this?
Yes.
Yes. So what are the various things that you have? Management commentary, I told you, management discussion and analysis. CSR reporting, I told you. Business responsibility reporting, I told you. There is also growing trend towards integrated working. To To ensure effective communication, consider the annual report as a whole and deliver a consistent and coherent message throughout. Okay. Outside the financial statements also, you have certain reports like, for example, environmental reports, value-added statements, particularly in industries in which environmental factors are significant and employees are regarded as an important user group. Okay, so did you understand this?
Yes.
Yes, इसमें कुछ है नहीं. Okay. So now what I want you to do is, we have certain case studies which are based on Ind AS. I want you to read case study 1 and tell me what is happening here. Read it. Just give me a minute. Could you read the question?
Yes, read the question. Yes.
Okay. So what is there? The company has given a housing loan of 15 lakhs to its employees with an interest rate of 6%, which is repayable in 5 equal annual installments with the interest amount. Employee is not required to give any performance against this benefit. Similar loan carries 10% interest. So is this a benefit that is given? Answer is yes. Ideally, they should have charged 10. They have charged at 6. So now company has recognized the staff loan in the balance sheet equivalent to the amount of housing loan disbursed, that is rupees 15 lakhs. Interest income for the year is recognized at the contracted rate, that is 90,000, which is nothing but 15 lakhs into 6%. Analyze whether the above accounting treatment made by accountant is in compliance with the relevant Ind AS. If not, advise the correct treatment of housing loan, interest and other expenses along with workings and applicable Ind AS. And also mention how the housing loan should be reflected in the Ind AS compliant balance sheet of Star Limited. What do you think? Is the treatment correct? Sanjay?
I think the interest should be taken as 10% and the
Interest
fair
should be
value
taken at 10%, correct?
fair value that
fair value that, correct? तो आप उसको 10% rate लेके you will discount it, calculate the fair value and then unwind the discount.
Unwinding the, yes.
Okay, ठीक है? So let us just run through the solution. Fair value of the loan you will calculate as follows. You will be paying the principal over 5 equal annual installments, so 3 lakh rupees end of each year. Interest on this, the coupon rate, that is also something that you will pay. So 90,000, 72, 54, 36 and 18. Are we okay with this? Yes. So total inflow 3 lakh 90, all these things put together. Discounting factor is taken. So the fair value of your loan is 1354,602. 13 lakh 54,602. Are we okay with this?
Yes.
Yes. And now you will unwind the discount. You will unwind the discount. So from 13 lakh 54, you will ultimately add the interest at 10%. Repayment including interest you will write. Amortized closing balance will be given to you. Are we okay with this?
Yes, sir.
Yes. Same for the next 4 years. Same for the next 4 years. Okay. And here you are given the journal entries. 15 lakh is money gone out. Loan to employee 13 lakh 54 and prepaid is 145 398. Are we okay with this?
Yes.
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 Then you will have to recognize interest, right? So bank account debit 3,90,000 to finance income at 10%, 135 460 to loan to employee 254 540. Are we okay with this?
Yes, sir.
Yes, you know where these figures are coming from, right?
Yes, sir.
This is the first repayment. So bank account 3 lakhs plus 90,000 coupon to finance income to loan to employee account. Employee benefit cost account debit to prepaid first lot. Are we okay with this?
Yes, sir.
Yes. Following is your housing loan. Following is your extract of the balance sheet of the housing loans. So you have loan to employee 8 lakh 38, which you will be split loan to employee 11 lakh. This you will be splitting into two parts. One is current and one is non-current. Okay, because what is going to be realized in the next 1 year will be current. What is beyond 1 year goes in as non-current. And you have prepaid employee cost also appearing in the balance sheet. Yes or no?
Yes, and this has to be shown every year for next 4 years.
This has to be shown every year. Okay, are we okay with this?
Yes. Yes, yes.
Okay. This is the question that is there as it is as far as exam is concerned. But in reality, yes, practically, tell me how would you handle this? Suppose you have 100 employees. Suppose you have 100 employees and all these 100 employees have taken loans. Have taken loans. Yes. Will you? I'm talking from a practical perspective. Ind AS I will bring in later. If I pass this entry, what can happen? Think and answer. See, I'm getting into a slightly different topic. Okay. If you pass this entry, broaden your vision. Right now, your vision is focusing on Ind AS, which is correct, but slightly remove those blockers and tell me what is it that will happen if I post this entry in the books.
There will be a huge prepaid employee cost.
ठीक है. But what is ultimately going to think from a practical perspective? Forget Ind AS. Think from a practical perspective. Okay. Let us suppose you are the employee. I am the employer. I have given you this loan worth 15 lakh rupees. Now you tell me if this is the actual entry that I pass. Yes. Loan to Sanjay 13 lakh 54. Prepaid employee cost 1 lakh 45. To bank 15 lakhs. How much are you going to repay me?
15 lakhs?
You have to repay 15 lakhs. Reporting is one side of the matter. But commercially, you have to pay me 15 lakhs along with interest. Yes or no?
Yes, the loan to employee will be lower than this.
Loan to employee, here, if you post this entry, what will happen is loan to employee will be lower than the recovery that is going to come in. Yes or no?
Yes, sir.
Sure. Did you follow?
Yes, sir.
All right. Next. Would you want to do this? You want to do this?
No.
No. Because at any point of time, when an employee asks you, sir, मेरा loan balance कितना outstanding है? Will you refer the Ind AS balance to tell the employee आपका loan balance is 13,54,000. Employee बोलेगा मैंने repay कब किया that it has become 13,54,000. Yes or no?
Yeah. Yes, yes.
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 So therefore, you will not disturb the loan to employee account under any circumstances. Yes. You will route it through separate control accounts that you will maintain for this purpose. Is it okay?
Yes, got it. Yes.
Yes. My
Yes, sir.
basic substratum, my balance, I cannot modify that. I cannot modify that. Is it okay? Any
Yes, sir.
index adjustments, you do it through a separate uh, what you say, anything else, you do it through a separate control account without disturbing the original amounts. Are you okay with this?
Yes, sir.
Yes?
Yes.
All right, fine. Similarly, on similar grounds, let us suppose market rate is 10%, loan is given to you at 6%. For tax purposes, what is that 4% which is benefit given to you?
Perquisite.
Perquisite. So for the taxman, do you think he will understand 13 lakh 54 and 1 lakh 45 and 15 lakhs?
No.
नहीं, उसको समझेगा 15 lakh with a 6% coupon rate, but market rate is 10%. So 4% पे please collect the tax. Yes or no?
Yes, sir.
Yes, did you follow? So that is as far as your practical issues are concerned. We covered two practical issues based on the same question. Are we having any doubts here?
No, but the company will have to maintain separate some data where they can find out how much is
Company will have to
allowed.
maintain a working, and based on the working, company will post entries in control accounts. They will route it through these accounts only when there is a sale that has happened. Only when there is a, sorry, 1 second, I was seeing the next
Loan.
question. Okay, only when there is a loan. Are we okay with this?
Yes, sir.
Yes. तो आप बेसिक अकाउंट्स चेंज नहीं करेंगे, यू विल रूट दीज एंट्रीज फॉर इंड एस थ्रू कंट्रोल अकाउंट्स. इज इट ओके?
Yes, yes. Okay.
It is one of the fundamental issues that we face in preparation of Ind AS financial statements. Yes.
Yes,
In
sir.
fact, for one of the public sector companies, a very well known, a very reputed public sector company, what they have told us, I mean, this is something that they have shared with us, that we prepare Ind AS financials only for the purpose of financial reporting. But our monthly MIS जो होता है, my monthly reporting pack, my monthly results, all of that goes on the basis of regular accounting standards. That is your accounting standard regime. Yes, all these Ind AS adjustments are taken care of by the reporting team and they are done properly. I'm not saying they are not done. But for the internal reviews that the management does do, for the purposes of allocation of resources, allocation of capital, strategic decisions, business lines, which is performing, which is not performing. All this data is prepared keeping in mind accounting standard regime. Is it okay? Yes.
Yes, yes. Yes.
Because the accounting standard regime does have certain advantages over the Ind AS regime. Yes, and that makes it simpler for companies to understand. Baki, all these things, splitting, from what you can say, from loan to prepaid, doing that split, doing the accounting, doing the adjustment entries, then doing everything back to make the repayment. All these things are round tripping. End of the day, what happens when this loan gets due for settlement? That time your EIR based accounting also would have come up for settlement, and payment of same amount will settle in both the sides. Yes or no?
Yes, sir.
Yes. So therefore, all what we are working around ultimately comes back to the square position, generally more often than not, when we do a complete cycle. When we do a complete cycle. Are we okay with this?
Yes, sir.
Yes, sure. So that is why Ind AS financials are not very, very friendly for analysis by the operational teams. Yes, they will not understand this.
Yes, and
That
they
is
should
some.
be adding
Mhm.
cost and resources to that public company you said.
They
They are
should be
preparing,
adding.
yeah, you mentioned that public sector companies
Uh-huh.
preparing financial statements on Indian GAAP. So it must
Yes.
be adding cost and resources, additional cost and resources to
Cost
the overall.
hoga, but you see, it adds a level of predictability also. Let me give you a very simple example. आपने Ind AS 116 पढ़ा है?
Yes,
Yes.
yes. Needs
Ind AS 116, what does it do? Your predictive cash flows of rent, which you pay every month. Say you pay property rent of 75,000 per month. What does Ind AS 116 do? Ind AS 116 converts it into a lease liability and an ROU asset. Yes,
yes, yes,
that lease liability you repay, and every month interest gets accrued depending on the incremental borrowing rate. Yes, and on the
yes,
ROU asset you charge the depreciation. Yes.
yes, yes, yes.
Now look at this. Where is the predictive element that we are having in these financials? If I have to look at the cash flow, can I directly get the cash flow impact for the next 3 months or 6 months? Every time I have to go back and revisit the lease liability amortization table. Yes or no?
Yes, yes,
To see कि मेरा liability कितना कम हो रहा है, कितना ये हो रहा है. But end of the day, from a common man perspective, is 75,000 just a cash outflow towards a facility that is given on rent to us?
yes,
Yes. So therefore, for the management seated there, treating rent as rent saves their time and resolves the issues for accounting and predictability. Yes or no?
yes,
So that is why they prefer that. In a boardroom, we cannot sit and debate about the finer aspects of things like, sir, this index requires this to go in debt, this to go in finance cost, etc., etc. Are we okay?
yes, yes,
Yes. मैनेजमेंट को नहीं समझ में आता है. They don't understand. These are operational entities who don't really understand. Okay. So they would prefer something which they are very, very familiar with. Preference share capital. Where do you show redeemable preference shares? Where do you show under Ind AS?
financial liabilities
Financial liability. But what are the management side people used to treating preference shares as?
as share
Share
capital.
capital. For so many decades, you have been showing it as share capital. Yes or no?
Yes, yes,
So they want to show it. The moment you put it in borrowings, the management will ask, हमने borrowing कहाँ से लिया? Yes.
yes,
And you tell them, sir, these are preference shares. But that is capital. Yes or no?
yes, yes,
Acha. Let me go one step further. Have you would have been studying Companies Act, right?
yes.
Companies Act, you open section 43. Yes, you open section 43. All right. Let us do one thing now. We'll see if I can open it here only for you. Okay. My screen is visible, right?
Yes, yes.
Okay, fine. So now let us open. You can see
Yes.
kinds of share capital. The share capital of a company limited by shares shall be of two kinds, namely A, equity share capital, B, preference share capital. So, under Companies Act, where is preference shares appearing?
Share capital.
Under share capital. But under Ind AS, where it is appearing?
Yeah, financial liabilities.
As a financial liability. These small, what you can say, inconsistencies do exist. These small inconsistencies do exist in your reported numbers vis-a-vis the Companies Act. Yes. And
Yes.
that is where things start to get a little, what you can say, you may feel it a little out of place. Sir, Companies Act is telling this. We are showing as financial liability. And somewhere you would have studied, Act is overriding this. So what are we supposed to do? Yes. So don't leave the thread of Ind AS for reporting purposes. Okay. When I have to report my numbers, when I have to get them audited, when I have to do a limited review, all those things, Ind AS never lose sight of that. But for your internal reporting, you will always find that Ind AS will not fit in those rooms. In fact, a routine P&L also does not sit in those rooms. When we have to take decisions for operations, when we have to take decisions as far as make or buy decisions are concerned, or as far as you're having decisions regarding to leasing or buying, all these things we don't even rely on traditional accounting methods. We would prefer to do it in terms of the in terms of what you call it as the managerial accounting norms, where you have variable cost, contribution, fixed cost, arriving at the profit. That is something that we prefer because that will give us an idea of where do I need to put my capital, etc., etc. And those financials, those results have no bearing to my Ind AS numbers. Yes, but
Yes.
there will be a sound reconciliation between both of them. There will be a reconciliation. Are we okay with this? Yes?
Yes. Yes.
All right, fine. So now coming back, this is the one. Deferred tax you should be recognizing. However, in absence of a tax rate, no deferred tax has been recognized. Are we okay with this?
Yes.
Yes. In fact, let me just also tell you one thing. Okay. You would have prepared Ind AS financial statements. Yes.
Yes.
From those financial statements, let me ask you, what is net worth? What will you tell me? Net worth kitna hai? If I ask you, sir, look at the balance sheet, equity capital plus other equity, whatever is there, including retained earnings, that becomes your net worth. Yes or no?
Yes. Yes.
Now, for the purposes of Companies Act, look at the definition of net worth. Yes, kidhar gaya? Number 57. You can see this? Yes.
Yes. Yes.
What is
Yes.
net worth defined here? It means aggregate value of the paid up share capital. Yes or no?
Yes.
What is paid up share capital? It means aggregate amount of money credited as paid up in respect of shares issued. And what do you mean by share capital? We just now saw section 43
Share
includes
capital includes preference share capital.
preference share capital. Abhi, just think about it. I'm going one more step further. Suppose we have issued convertible preference shares. What do you do with convertible preference shares?
Yeah. So as compound
Something
financial
will
instrument,
come in equity component,
yes, compound financial instruments,
something will come in liability component,
liability. Yes,
something will go and sit as finance cost. Yes.
yes, yes,
But for your Companies Act, yes, that is supposed to be your share capital only. Yes or no?
yes,
These are some interpretations that are there, which are floating around. Yes. Okay. So when I look at this per se, directly putting the net worth figure from the financials into the net worth definition under Companies Act may not seem similar, identical. There will be some differences. There will be some differences. Is it okay?
yes, yes,
Yes. तो ऐसे चीजें आपको बहुत सारे मिले. You will find lot of what you can say, a lot of inconsistencies. That is the way the statute has been framed. The Companies Act 2013 was the brainchild of the Companies Act 1956. Yes.
yes,
And 1956 did not have Ind AS. So therefore, when 2013 was introduced, Ind AS was but a very nascent, uh, what you can say, was but a very nascent topic at that time. So they just brought forward the provisions. They did some minor changes, but they retained most of the things in the same manner. Is it okay?
yes,
Yes.
yes,
So
okay.
that is why you have these kind of inconsistencies floating around. Okay. Our job is to question those inconsistencies, definitely. But second and most important, we have to work around those inconsistencies. We cannot say inconsistency hai, I will not work. No, inconsistencies will be there. You just have to find a way to work around. You are driving your vehicle on a road. You have a pothole. इंडिया में हर जगह होता है. Yes, क्या करते हो आप? Will you say मैं गाड़ी नहीं चलाऊंगा? You will try to go through the left if you can avoid the pothole. You will try to meander to the right to see if you can avoid the pothole. If that also doesn't work, you will try to place the pothole, your car over the pothole so that from the side your tires will go off, but you don't enter the pothole. And kabhi kabhi pothole aise hote hain, whatever you do, you will go in the pothole, but you will come out of it. That is how it is in reporting also. You will have inconsistencies. You will have difficulties. It is not easy to explain to the authorities also what is Ind AS. In fact, in one of our experiences, you understand deferred tax, right?
Yes,
This has really happened. I'm not making this up. In one of the cases where we had hearings for one of our entities, the tax officers, in the course of assessment, in the balance sheet, they saw deferred tax liability and they said pay it up. Because you are only admitting in your financial statements that you have deferred some tax liability, pay it to us right now. And they raised the demand also equal to the deferred tax liability that we had disclosed in the financial statements. Now, ये कौन सा pothole है? You cannot even cross, go to the left, right, or above. You have to go through that and come out of it. Yes or no?
yes, yes,
होता है ऐसे, it happens. It is very technical. You just imagine how are you going to explain to such authorities ki bhai what is deferred tax? But we had to make that effort because this is not a demand that has to be raised. This is a financial reporting requirement. This is an adjustment that needs to be made pursuant to financial reporting. It's not a tax demand. Yes. And
yes,
then
yes,
after discussing, after running them through the provisions, making them understand, then they took it forward and then they said, okay, fine, we agree, we understand. But that is how it is. People are still very comfortable with the accounting standard regime. Things were very simple there. Ind AS has definitely made things complicated, but that is because we have a broader vision in mind. The broader picture is we as a country have to reach the standards that are being adopted globally. Today, I cannot be isolated and follow my own gap regime because enterprises are going global. And therefore, you need to have a framework that ties up with what is globally being followed. And I'm sure there also, internally, the issues may be something different altogether. Okay. So, in all these things, Ind AS becomes very vital from compliance perspective, very vital from reporting perspective. But managerial decisions, there could be alternative frameworks present. Are we okay with this?
Yes.
Yes, now come to
Yes.
case study 2. Okay, come to case study 2. Case study 1 is done. Case study 2, read it and then we will discuss what is the solution, right?
Yes. Go on through
Done.
this.
Okay.
Yes.
What is happening here? The
Yeah.
company has stopped using the manufacturing plant because of decline in demand. Okay. They had purchased plant for 6 lakhs with a useful life of 10 years. The plant is maintained in a workable condition and it will be used in the future when demand picks up. Does it happen? Yes.
Yes. It happens.
Very common. Very, very common. Okay. होता है. The accountant of Pluto decided to treat the plant as held for sale until demand picks up. Is this treatment correct? You remember a
Yes.
few years ago, there was an issue with Maggie that was being produced. Yes?
Yes. Yes. I remember.
Traces of lead or something were found, some harmful chemical or some metal. So what did Nestle do? They burned all the stocks that they had. Yes,
Yes. Yes.
that time the machinery would have been idle.
Yes.
Do you think they would classify it as held for sale?
No.
No, they will use it after this whole issue and this whole what you can say whole issue gets resolved, and with the authorities what you can say with the authorities permission and license, they would again resume the production of the food item. Yes or no?
Yes. Yes.
Do you think that in this gap of whatever, let us suppose it ran across 2 years when the machines were idle, do you think it is held for sale? Answer is no. It is not held for sale. We are maintaining the plant in a workable condition because we do intend to carry out the activity when demand picks up. Yes. So therefore, you are ultimately in a position where you have left an asset idle but in a working condition, and therefore treating it as held for sale doesn't work. So now what he has done, he has stopped charging depreciation. Number one, can he do that?
No. he has to charge
तो जो
depreciation.
depreciation charge नहीं किया, you will have to charge that. The fair value less cost to sell on 30th September 20x3 was 4 and 3.5 lakh for 31st March 20x4. Are we okay with this? Yes.
Yes.
So the
Yes.
following information he has given: purchase price of plant 6 lakhs, depreciation 2.5 out of 10 years, 4 lakh 50. Fair value less cost to sell is 4 lakhs. The value will be lower of the two, that is 4 lakhs. Are we okay with this?
Yes.
Yes. Okay. You have other current assets and assets classified as held for sale, 3 lakh 50,000. Above treatment needs to be examined. Okay. Now you tell me, classify as a non-current asset as held for sale if carrying amount will be recovered through a sale transaction rather than through continuing use. Are we okay with this?
Yes. Yes.
Yes. Now,
Yes.
you are given Ind AS 105 guidances. So going by the guidance, the accountant of Pluto has treated the plant as held for sale, measured it at fair value less cost to sell. Also, depreciation not been charged thereon since the date of classification, which is not correct and not in line with 105 and Ind AS 60. Are we okay with this?
Yes. Yes. Clear.
Yes. So therefore, manufacturing plant should neither be treated as abandoned asset nor as held for sale, because carrying amount will be principally recovered through continuous use. Are we okay with this?
Yes. Yes.
Not stop charging depreciation or treat the plant as held for sale because its carrying amount will be recovered principally through continuing use to the end of its economic life. Yes. So
Yes.
purchase price was 6 lakhs. Depreciation for 3 years, 1 lakh 80. So it comes to 4 lakh 20,000. Okay. 3 lakh 50, and you have your impairment loss of 70,000. Are we okay with this?
Yes.
Yes. So in non-current assets, you have PPE worth 3 lakh 50,000. Okay. Yes.
Yes. Yes.
Is it clear? Did you understand the
Yes.
question?
Yes. Yes. Clear.
Okay, fine. Great. So that takes care of case study 2. Okay. Now go through case study 3. Let's come. Did you go through?
Yes. Yes.
Acha, what is happening here?
Yeah, the inventory is damaged, and the company has
Okay.
added additional
Company has
amount.
treated it as an adjusting event. Yes.
Yes. Yes.
When did the fire happen?
Before
On
on
5th
5th
April
yeah, after,
20X2.
yeah,
Yes.
after reporting date. Yes.
Inventory manufactured prior to 31st March. Correct?
Correct. Correct.
So you had cost of 8 lakhs. This is the cost of the inventory. You have net realizable value estimated at 9.6 lakhs. Because of the damage, further 2 lakhs would be your cost of repairing the damage. So NRV is 7.6.
Yes.
So he wants to show the inventory at 7.6. Are we okay? Yes?
Yes.
समझ में आ गया?
Yes, yes.
Okay. Now you tell me, can he do this? Can he treat it as an adjusting event? You have studied Ind AS.
No,
No. Why no?
because the condition there were not conditions existing on the balance sheet date. The fire occurred
Exactly.
after. Yes.
Exactly. The condition is fire to the inventory. That has happened on 5th April, not on 31st March. And therefore, you cannot treat it as an adjusting
Existing.
event. At the most, you could treat it as a non-adjusting event. Okay. So therefore, and give a disclosure. So cost is 8, net realizable value is 9.6. So you will disclose it at 8 itself. Are we okay with this?
Yes. Yes. Yes.
Yes. No doubts? Okay.
Clear.
Fine. Now, come to case study 4. Okay. See, all these things are easy to read and give the answer. But when you actually write down, you will have to write some literature in terms of what the respective standard tells us. What is the scenario here? What should be the final answer? What is the answer that you have given? And where is the difference? Is it okay?
Yes, sir.
Yes?
Yes, got it.
All right. Fine. So now read case study 4.
Yes. Right.
Okay. So what I'm having three CGUs, A, B, and C. They are having fair value 12, 8, and 4. And there is goodwill relating to C. So I have A, B, C. C is having goodwill also. Yes.
Yes.
During financial year X2, X3, the CFO of the company has a view that there is no requirement of impairment testing for any CGU since the recoverable amount is higher and there is no indicator of impairment. Analyze whether the view adopted by CFO is in compliance with Ind AS. If not, give the correct treatment. You have studied Ind AS 36, right?
Yes. Impairment. Yes.
Impairment. You will have to do an impairment testing if there is an indicator of impairment. Yes or no?
Yes, sir.
A and B do not have any impairment indicators. So you can avoid testing for impairment. Sir, but C also doesn't have, it is given now that C also does not have indicator of impairment. Yes or no?
Yes. Yes.
Then what is the special thing for C? The special thing for C is that it is having goodwill. And when you have goodwill, the standard
Impairment.
is clearly mentioned that whether or not you have indicators of impairment, you will do an annual testing for
Impairment testing. Yes.
impairment. So therefore, CGU C you will compulsorily do your impairment testing. Are we okay with this?
Yes.
Yes. So accordingly, impairment testing for A and B not required. C shall be tested as the goodwill acquired on business combination is fully allocated to CGU C. Are we okay with this?
Yes. Yes.
Yes. Okay, fine. Okay. Now we have a big question. Okay. This is a huge one. Okay. Second. I want you to read this question 6. Okay.
Okay. Okay.
Yeah. Read this. Just come. I'm alone at home. There's nobody. I'll just come. Did you go through the question?
Yes, first part
First
I've
part you
answered.
could go through. Okay, fine. So now, what do you think? Owing to the proposed schedules, Mumbai Challengers needs a new stadium to host the sporting events, which will form a part of property, plant, and equipment of the company. Mumbai began the construction of the stadium on 1st December. Construction was completed in 20X2X3. Costs directly related to the construction amounted to 140 crores in December 20X1. Thereafter, 350 crores have been incurred per month until the end of the financial year. Company has not taken any specified borrowings to finance the construction, though it has incurred finance costs on the regular OD during the period, which were avoidable had the stadium not been constructed. Mumbai Challengers has calculated that the weighted average cost for the borrowings for the period 1st April X1 to March X2 amounted to 15% per annum on an annualized basis. The company seeks advice on the treatment of borrowing costs in its financial statements for the year ending 20X2. What do you think? Yes,
Yes, we will allocate this borrowing cost.
you
Uh,
will allocate this borrowing cost. Yes,
yes,
you
yes,
will have
because
to
these are
capitalize
general
the
borrowing.
borrowing cost. Yes,
Yes, capitalizers.
because first of all, this qualifies as a qualifying asset in terms of, I think, Ind AS 23. And therefore, even though I have not taken specific borrowing, they have mentioned that I'm taking it from the overdraft facility that the company already has. And if the stadium construction was not carried out, these costs could have been avoided. Yes or no? So this is an indicator that the borrowing cost has been incurred specifically for constructing this particular asset. Are we okay with this?
Yes,
Yes. So in terms of your costs incurred in December 20X1. I incurred 140 crores, 15% for 4 months, December, Jan, Feb, March, 4 months. So 140 into 15% into 4 by 12, that gives you 7 crores. Yes.
yes,
Then in January, I incurred 350 crores out of the overdraft. So 350 into 15% into 3 by 12. January, February, March. Is it okay?
yes, yes,
February again 350. They have told 350 every month. 350 15% into 2 by 12 and 1 by 12. So total 33.25 crores is what you have incurred. Are we okay with this?
yes, yes,
Yes, so this is one way of doing it. Or weighted average carrying amount of the stadium is 140 plus. Yes. All right. Weighted average carrying cost is 140, 490, 840, 1190. You know how these figures are coming up, right? First month I incurred 140 crores, correct?
yes,
Second, January month, 140 already incurred of December plus 350 of January. So that comes to how much?
okay, yeah,
490.
490, yes,
490 YTD January plus 350, 840. Yes.
yes,
And
350
840 February YTD plus
plus
March
350.
1190. Is it okay?
Yes, yes, okay.
So these are the costs I have incurred cumulatively divided by 4. So it comes to 665. This, when you multiply it by 15% into 4 by 12, you get the same figure. Okay. This is
Yeah,
arithmetic. This is not accounting. Okay. ऐसे भी कर सकते हैं, वैसे भी कर सकते हैं. Anyways, you can do it. Is it okay?
yes, yes,
Yes. So you will be capitalizing it. Okay. 33.25 crore worth of borrowing cost we will be capitalizing. Next. Shall we proceed further?
yes,
Yes. All right. Mumbai Challengers acquires and sells players' registrations on a regular basis. For a player to play for its team, Mumbai Challengers must purchase registrations for that player. These player registrations are contractual obligations between the player and the company. The cost of acquiring the player registration includes transfer fees, league levy fees, and players' agents' fees incurred by the club. At the end of each season, which happens to be the reporting period ended for Mumbai Challengers, the club reviews its contracts with the players and makes decisions as to whether they wish to sell or transfer any of these registrations. The company actively markets these registrations by circulating with other clubs a list of players' registration and their estimated selling price. Player registrations are also sold during the season with performance conditions attached. In some cases, it becomes clear that a player will not play for the club again because of, for example, a player sustaining a career threatening injury or being permanently removed from the playing squad for any other reason. The playing registrations of certain players were sold after year end for total proceeds net of associated costs 175 crores. These registrations had a book value of 49 crores. The club seeks your advice on the treatment of acquisition, extension, review, and sale of registration in the circumstances outlined above. Yes, what do you think? Interesting?
Yes.
Yes. So, what do you think? Take take any case, na. Take for example, you are having. This is basically an IPL question. Yahan ka wahan, we have just made the names upar niche bas, okay? Because we could not use the same names for practical purposes. So take any IPL club, any IPL thing that is happening. You are aware of the auction that happens, right?
Yes.
See, I'm not much of a follower, but kahin pe some hotel, some resort, these people hire, and then there they do the auctioning of the players. Then somebody gives up a player because they want a better player. Then somebody shows interest in the player who has been given up by one of the team. And you have certain icon players who have remained with the club ever since it started. Yes. So all these scenarios, whatever is there in the question, is basically what happens in your IPL auction or any other auction for that matter. Yes or no?
Yes.
So when a player is bought on board, okay, जब आपने player को खरीद लिया, okay, when you have purchased or when you have acquired a player, what is it actually? You are entering into a contract with that player. What contract? That you will play for us, you will promote our club, you will perform to the best of your abilities for the benefit of our club, and you will ensure that you will do everything it takes to win the trophy. Yes or no?
Yes.
So, can I say that I am purchasing a player for winning a trophy? Yes.
Yes.
And that trophy comes with prize money.
Yes.
So who gets the prize money? It is the club who is getting the prize money.
Yes.
Yes. Okay. Who is delivering the prize money to you? The player who win the match gives the prize money to you. Yes or no?
Yes.
So can I say that the player, when performing, generates benefits that have monetary value?
Yes.
Yes. That means, can I say that when the player is in use, he is generating economic benefits to the club?
Yes.
Can I say that the player's services are generating economic benefits?
Yes.
So, can I say that services are something which cannot be seen, touched? So, therefore, services are something which is intangible in nature.
Yes.
Yes. So can I say that by buying a player, I have in effect entered into a contract by which I got an intangible asset which will entitle me to future economic benefits?
Yes.
So can I say that this intangible asset is acquired pursuant to a contract between the club and the player?
Yes.
कॉन्ट्रैक्ट होता है दोनों के बीच में, आप ये सीजन हमारे साथ खेलोगे, नेक्स्ट 3 years हमारे साथ खेलोगे. दैट इज द काइंड ऑफ कॉन्ट्रैक्ट्स दैट यू हैव. Yes.
Yes. Yes.
And therefore, now you tell me, this player contract, can I treat it as an intangible asset?
Yes.
Yes. When I treat it as an intangible asset, what I pay to the player will go. Then I have to pay something to the board also because they're organizing. Yes. Then I have to pay something related to transfer fees also. Then I have to pay something to the players' agents also. Yes. So can I say all these are costs directly related to acquisition of the player?
Yes.
So therefore, can I say they will also need to be capitalized?
Yes.
Yes. So that is exactly what the first part is telling. Is it okay?
Yes. Yes. Okay.
No doubts. Okay. Next. They told that sometimes players are put up for sale. Yes. So, and when the player is put up for sale, do you think it will be done in secrecy? Chalo, I release this player and I keep quiet about it. Can it happen?
No.
No, it cannot happen. Yes. So when a player is put up for sale, you will typically be having announcement made. Yes, that look, we are releasing XYZ player from our squad. Yes, this was his last year's price. You see what price best fits and then take a call. Are you able to follow?
Yes. Yes.
Yes. So therefore, when I have put forth a player on sale, can I say that the sale is highly probable?
Yes.
Number one. Number two, is it actively marketed at a price that is reasonable in relation to its current fair value? Answer is yes.
Yes.
More often than not, we take it at that value. In the given case, it would appear that management is committed to a plan to sell the registration. The asset is available for immediate sale and active plan is already in place by circulating clubs. 105 stipulates that it should be unlikely that the plan to sell would be significantly changed or withdrawn. To fulfill this requirement, it would be prudent if only those registrations are classified as held for sale where unconditional offers have been received prior to the reporting date. Are you able to follow?
Yes. Yes. Immediate sale
Yes.
in present condition, which is okay.
Yes. Once the conditions for classifying assets as held for sale is fulfilled, registrations would need to be stated at lower of carrying amount and fair value less cost to sell, with carrying amount stated in accordance with Ind AS 38 prior to application of 105, subject to impairment, if any. Are we okay with this?
Yes.
Yes. P&L on sale of registrations would be computed by deducting the carrying amount of the sales registrations from the fair. Is it okay? So the sale value here minus whatever is the carrying amount in my books, that is going to be your profit on sale of
Profit.
intangible asset. Are we okay with this?
Yes. Yes.
Yes.
Yes.
Simple.
Yes. Simple.
In case a portion of the consideration is received for occurrence of a future performance obligation, this amount recognized in the statement of P&L only when the conditions are met. Are we okay with this?
Yes.
Yes. Okay. Fine. Players' registrations disposed of after the year end is a non-adjusting event in accordance with Ind AS 10. You are disposing after the year end. So that is going to be a non-adjusting event. Is it okay? Yes. Any doubts?
It could be adjusting event also because conditions are existing at date of
One minute.
financial statements.
Look at the question. The playing registrations of certain players were sold after the year end for total proceeds. जब sale ही after year end हुआ हो, you cannot treat it as an adjusting event, right?
Okay, yes,
Yes.
yes,
All right. And then somewhere they have shown that some players may be threatened with injuries. Okay, so that means my asset has become impaired. वो बेचारा काम नहीं कर सकता. He cannot run, do whatever activity that is required of him. So he will then be subjected to impairment. Okay. In the given scenario, it is not easy to determine the value in use of any player in isolation, as that player cannot generate cash flows on his or her own unless via a sale transaction or an insurance recovery. Whilst any individual player cannot really be separated from the single CGU, there may be certain instances where a player is taken out of the CGU when it becomes clear that he or she will not play for the club again. If such circumstances arise, the carrying amount of the player to be assessed against the best estimate of the fair value less any cost to sell and an impairment charge recognized in the P&L. Is it okay?
yes,
Yes, fairly
yes.
simple. All right. So that takes care of 6B. That takes care of 6B. 6C. Read 6C.
Yes, yes, gone through.
You have read? Okay. What do you think? Airline company has approached directors offering 700 crores for property naming rights of all the stadium for 5 years. आप नोएडा में रहते हो ना,
Yes, yes,
तो आपके मेट्रो स्टेशन पे कभी कभी कंपनीज के नाम होते हैं.
yes, yes,
यस,
yes,
होंगे. लाइक इन बैंगलोर ऑल्सो वी हैव सर्टन मेट्रोस. आपके यहाँ पे भी होंगे. ओके, आई मीन आई हैव बीन टू दिल्ली बट मुझे याद नहीं है. ओके, बट देर आर क्वाइट सम फ्यू. इंडसइंड बैंक, ये बैंक, वो बैंक, किसी न किसी का नाम लेके मेट्रो का नाम जोड़ देते हैं. यस.
yes.
So that is, now what is that actually? What is that? How do you treat that? In terms of 113, stadiums should be valued at price which would be received to sell the asset in an orderly transaction between market participants at the measurement date. Price would be the one which maximizes the value of the asset, right? Which maximizes the value of the asset or the group of assets. This we have always studied in fair value also, that in case of non-financial assets, highest and best use is the metric that we use for determining the fair value. Yes or no?
Yes, yes,
Price would essentially use level 2 inputs, which are essentially other than quoted market prices within level 1, which are observable for the asset or liability directly or indirectly. Property naming rights present complications when valuing property. The status of the property indicates its suitability for inviting sponsorship attached to its name. It has nothing to do with the property itself, but this can be worth a significant amount. Therefore, they could include property naming rights in the valuation of the stadium and write it off over 3 years. Are we okay with this?
Yes, yes.
Yes. ठीक है. No, something about directors they had asked. 3 directors are on the management board of both Mumbai Challengers and the airline. And additionally, statutory legislations regulate the financing of both cricket and hockey clubs. These regulations prevent contribution to capital from a related party which increases equity without repayment in return. Failing to adhere to these legislations could lead to imposition of fines and withholding the prize money. Okay. Now, Ind AS 24, two entities to be treated as related parties is discussed. Such criteria includes being members of the same group or where a person or a close member of that person's family is related to a reporting entity if that person has control or joint control over the reporting entity. Ind AS 24 deems that parties not related just because they have a director or key manager in common. In this case, there are 3 directors in common, and in the absence of any information to the contrary, it appears as though the entities are not related. However, regulator needs to establish whether sponsorship deal is a related party transaction for the purpose of financial control provision. There would need to be demonstrated that the airline may be expected to influence or be influenced by the club or a related party of the club. If the deal is deemed to be a related party transaction, evaluate whether it is at fair value or not. Are we okay with this?
Yes.
Any doubts? कोई doubt है?
No.
Sure.
Sure.
Okay. So that takes care of question number 6. So far, so good. Are you okay?
Yes.
All right. Fine. Fine. We take a break and then we shall continue. Yes,
Okay.
we take a 10-minute break. It's 8:35. We resume at 8:45. We shall look at the remaining 2 case studies and then I think some test your knowledge before we wind up the session. Okay?
Okay.
10 minutes break. let us come on to this question. Slightly big one, but I think we should be able to do that. Okay. Case study 5. Deepak started a new company, Soft Bharati Private Limited, with Iktara Limited, wherein investment of 55% is done by Iktara and rest by Deepak. Voting powers proportionate to the share capital. The new company formed was the subsidiary of Iktara Limited with 2 directors, and Deepak eventually becomes one of the directors of the company. A consultant was hired. He charged 30,000 for incorporation and other necessary statutory registrations. 30,000 to be charged as an expense in the books after incorporation of the company. The company Soft Bharati Private Limited was incorporated on 1st April 20X1. The financials of Iktara are prepared under Ind AS. An accountant who was hired has prepared the draft financials as below. You have revenue, other income, expenses, you have purchase of stock in trade, increase or decrease in stock in trade, uh, employee benefit expenses, depreciation, other expenses, profit before tax, tax expense, and profit for the year. Equity and liabilities, you have share capital, reserve surplus, non-current liabilities, you have long-term provisions, DTL, trade payables, other current liabilities, short-term provisions. Non-current assets, you have property, plant, equipment, long-term loans and advances, other non-current assets. Current assets, you have investment, inventories, trade receivables, cash bank and other current assets. Additional information. DTL of 6,000 is to be created due to the following temporary difference. Difference in depreciation amounts as per income tax and accounting profit. Okay. There is only one property, plant and equipment in the company whose closing balance as at 31st March is as follows. As per the books, 1 lakh, as per income tax, 80,000. Pre-incorporation expenses are deductible on straight line basis over period of 5 years as per income tax. Same is immediately expensed off in the books. Current tax is calculated at 30% on PBT 3,55,000 without doing any adjustments related to income tax. Correct current tax after necessary adjustments comes to 1,25,700. After the reporting period, directors have recommended dividend of 15,000 for the year March X2, which has been deducted from reserves and surplus. The payable has been grouped under other current liabilities along with other financial liabilities. There are government statutory dues amounting to 15,000 grouped under other current liabilities. Capital advances amounting to 15,000 grouped under other non-current assets. Other current assets of 51,000 comprise interest receivable from trade receivables. Current investment 30,000 is in shares of a company which was done with the purpose of trading. Current investment has been carried at cost in the financial statements. The fair value of current investment is 50,000. Actuarial gain or employee benefit measurements of 1,000 is omitted in the financials of Soft Bharati for the year ending March X2. The financial statements for X1, X2 have not yet been approved. Ascertain whether the financial statements are correctly presented as per the applicable framework. If not, prepare the revised financial statements after analysis of above mentioned facts and information. Are we okay with this? Understood the question?
Yes.
Yes. So plain simple things, you just have to do the what you just have to move it to Ind AS. That's it. Otherwise, there is nothing major in this question. Okay. All right. Fine. So now let us start up with okay. So we start off with the P&L. P&L revenue from operations has no adjustments. Other income I already have 1 lakh coming in from here and another 20,000 will flow in, right? See, they already have 1 lakh as other income. Yes? Yes or no?
Yes.
And in this adjustment, fair value is 50,000 minus 30,000. So the gain of 20,000 goes and sits under other income. Are we able to follow?
Yes. Yes.
Yes. So that is why my other income is worth 1,20,000. Okay. So that is 11,20,000. Next. All these items. 5 lakh 50, 1 lakh 75, 30 and 90. As it is, there is no adjustment. 7 lakh 45. Are we okay with this? Yes.
Yes.
So profit before tax comes to 3,75,000. 3,75,000. Any doubts?
No, clear. Clear.
No doubts. Okay. Next. Adjustment 4. Current tax is calculated at 30% on PBT. So what is your current tax? 3,55,000 into 30%. So that gives you 106,500. Yes or no?
Yes.
This 106,500 is what is already appearing in the P&L. You can see this.
Yes.
Yes. But this cannot come in here. What is to come in here is 1,25,700 after considering all income tax, allowances and disallowances. Yes or no?
Yes. Yes.
So you will take 125,700 as your P&L figure. Is it okay?
Yes.
All right. Next. Taxes. Deferred tax. What is the deferred tax currently appearing? 6,000.
6,000.
Now, investments was 30,000 in my books. Yes or no?
Yes.
This 30 has become 50. Yes.
Yes.
This 30 has become 50. Can I say that there is a difference of 20,000?
Yes.
This difference of 20,000 at 30% rate. Yes.
Yes. 6,000.
6,000. Yes or no?
Yes.
So now, what is this? DTA or DTL?
DTL.
DTL or DTA? What is it?
The investment income has increased, so we have to pay the income tax.
Income has increased. Yeah, 6,000 gives rise to a DTL. Yes or no?
Yes.
All right. So current investment remeasurement. Okay. Next, we still have some adjustments for remeasurement. So let us not
Yes.
immediately jump to
PP,
post it.
PP.
Okay. Yes. Next, that is done. Okay.
Property, plant and equipment.
The first one, right? 1 lakh, and as per income tax, 80,000. So that also becomes a deferred tax adjustment. 1 lakh property carrying amount, 80,000 tax base, difference 20,000, 6,000 DTL. Yes or no?
ATL, yes. Yes.
Yes. And finally, you have something known as pre-incorporation uh, expenses. Somewhere they said na it is going to be written off over 5 years.
Yes.
Yes, somewhere it is written. Yeah, charge 30,000, which is an expense in the P&L, but for tax purposes, it will be accounted or it will be recorded based on 30,000. Is it okay?
Yes. Yes.
Yes. So this 30,000 based on the tenure under income tax, 5 years. So what did they give? Charge 30,000 as an expense, but they have given income tax treatment also. Mm, I'll have to see where that line is. 30,000.
That is in the beginning of the question.
Yes, 30,000 I got.
Okay.
Somewhere they have given tax expense, na? For tax purposes, write off over 5 years or 6 years. Here they have given charged as an expense in the books after incorporation. Here, over a period of 5 years. So 30,000 divided by 5, 6,000 each year. So for your deferred tax working, pre-incorporation in P&L, it is entirely written off. So carrying amount is 0. Tax base will be 24,000. 30,000 opening minus 6. So that gives you 24,000. Yes or no?
Yes. Yes.
So 24,000 into 30%, 7,200 DTA. So net what we will be recognizing is a DTL of 4,800. Are we okay with this?
Yes. Yes. Okay.
Yes. So this is also done. This is also done. Okay. Next. This is taken care of. This is taken care of. After the reporting period, directors have recommended dividend for year ending March X2 deducted from reserves and surplus. Dividend payable has been grouped under other current liabilities along with other financial liabilities. What do I do with this dividend payable? Yes,
Dividend, it has to be added
it has
back.
to be. You're right. Tell me.
Proposed dividend is not to be shown as an expense.
Proposed
So,
dividend is not to be shown as a liability. Are we okay with this?
yes.
Yes, so that will not appear. Is it okay?
Yes. Okay.
Okay, so that takes care of May 2026. I mean, in terms of your, where did that go? Dividend for the March period is taken care of. All right, next. There are government statutory dues of 15,000 grouped under other current liabilities. This will be moved where? Is it a financial liability? Is it a financial liability payable in cash? Yes
Yes.
or no? What is it? It is not a financial liability because it is statutory dues. Yes or no? Financial liability is always contractual, not statutory.
Not
Yes.
statutory. Yes. Yes. I was thinking about that. Yes.
So this will go under other current liabilities only. Capital advances are grouped under other non-current assets. Yes, which is okay. All right. They are not financial assets. There will be other non-current assets. Is it okay? Yes.
Yeah. Okay. Okay. Yes.
All right. Fine. So that takes care of this. Government statutory dues also we have taken care of. Capital advances, okay. Current assets of 51,000 comprise interest receivable from trade receivables. Current investment of 30,000, this also we have done. Actuarial gain, this will go to OCI. Okay, fine. The financial statements are not yet approved. Are we okay with this?
Yes. Yes.
Yes. So I think we have done all the adjustments. So my suggestion to you is you go through those adjustments and then try to prepare the balance sheet by yourself. You would like to do it right now?
Okay.
Okay, then try it out. Ind AS balance sheet, please. So you start up with assets and then end with liabilities.
Yes.
Okay. Yeah. Take 10 minutes and do this. Yeah, Deepak, done. Sanjay, done.
Not yet done. I'm just doing.
Okay.
Done, but there is difference between the balances, assets and
Let us see.
liabilities.
What is your asset side total?
Asset side total is 5,41,000.
वो तो ठीक है. Property, plant, equipment 1 lakh.
Yes,
Other financial assets, long-term loans and advances 40,000.
yes,
Other non-current assets, this is the uh, capital advances 50,000.
yes,
Then current assets, you have inventories 80,000.
yes,
Investment 30,000, opening 20,000, fair
yes,
value movement, so 50,000. Yes.
yes, yes,
Trade receivables 55,000.
yes,
Cash and cash equivalents 1 lakh 15. Other financial assets 51,000.
1,000.
Yes.
Yes,
So asset side is over. Liability side, you have equity capital 1 lakh.
yes.
Other equity,
The P&L
how
figure,
much
yes.
did you get?
Yeah, it is 2,45,200.
2,45,200. Provisions 24,000.
Yes.
Deferred tax 5,100.
I took 4,800 deferred
How
tax
much did you
left.
get?
4,800,
4,800.
which we calculated.
Uh-huh.
We calculated
We
4,800.
calculated in the table 4,800. Yes. Hmm. Okay, let us see. Trade payables 11,000.
Yes.
Other financial liabilities 15,000.
Yes.
Other current liability, that is government dues 15,000.
Yes.
Current tax liabilities 125,700.
Yes.
Yes. So you are getting 5,40,700, right?
5,25,700.
5,25,000.
Let me calculate again.
Just check.
Yes, 525,700.
1 second. 525. 15,000 you have added twice or only once?
Once.
You have to take twice now. See, in the original balance sheet,
Yes, other financial liabilities, I have missed it.
yeah. So when you add that 15,000,
It comes
done
to 540,700.
540,700. And then see, there is one adjustment for provision, right?
There is a remeasurement of net defined benefit plans given in the
That's what
question,
I'm
the answer.
seeing. Mm, which actuarial gain on employee benefits of rupees 1,000 has been omitted. So this 1,000 rupees actuarial gain on employee benefit measurements. This actually forms part of your long-term provisions, right? Yes.
Yes. Yes.
So this should be 25 minus 1. This should be 24,000, which you have already taken in your financials. Yes or no?
Yes. Yes. Yes.
So your tax base is 25. Your reporting number is 24. So difference of 1,000 into 30%, that gives you the DTL. Yes.
Yes. Yes. Yes. 300.
And in the comprehensive income, you would have taken 700, no?
Yes.
That adjustment I think you have done.
Yeah.
Okay.
Yes. Yes.
All right. Fine. That means 1,000 minus 300, 700. Is it okay?
Yes. Okay. Now.
So that matches your balance sheet. Is it okay?
Yes. Okay.
Yeah.
Okay.
Quite a long question. This is typically, we had our case study based papers initially before changing of the syllabus. You had those global financial reporting standards paper, GFRS. Yes. Do you recollect?
No.
It was
No.
there earlier. So this question was a part of that.
Okay. Okay.
That is why it is so huge. In fact, the last three questions are a part of that only. So 5 is done. 6 is done. Okay. I want you to do 7 for homework. Okay.
Okay. Okay.
7 is again theoretical in nature. I want you to try it out for homework. Okay. Next. Now, let us pull out some questions from here. Venus is a multinational entity that owns 3 properties. All 3 properties purchased on 1st April 20X1. Details of purchase price and market values of the properties are given as follows. You have purchase price, market value on March 20X2, life and subsequent measure. These are the uh, price market values which are given for properties 1, 2 and 3. Property 1 and 2 are used by Venus Limited as factory building, whilst property 3 is let out to a non-related party at market rent. The management presents all 3 properties in the balance sheet as property, plant and equipment. The company does not depreciate any of the properties on the basis that fair values are exceeding their statutory amount and recognize the difference between purchase price and fair value in the statement of P&L. Analyze whether the accounting policies adopted by Venus in relation to these properties is in line with Ind AS. If not, advise the correct treatment along with workings for the same. Did you understand the question? Yes.
Yes. Yes.
All right. So tell me, what should we do?
Yeah, we should depreciate the assets, take a carrying amount,
Okay,
then
but
check for any impairment.
tell me one thing. All the 3 properties are shown as property, plant, equipment. Is it right?
No, no. The third property is let out,
So let out property, where do you show?
investment property.
Absolutely right. You will have to show it as investment property. So if we look at question 1. Venus Limited has presented all properties as PPE, applied different accounting policies to 1 and 2, revaluation charged in P&L, applied revaluation to property 3, which is being classified as investment property. So these are the broad category of mistakes that are conducted. Their accounting treatment is neither correct nor in accordance with provision of Ind AS 1, 16 and 40. Accordingly, Venus shall apply same accounting policy to entire class of property, being property 1 and 2. Also required to depreciate these properties irrespective of that uh, their fair value exceeds the carrying amount. So depreciation is not a choice, you will have to depreciate it. Okay. There is no alternative for revaluation model in case of an investment property. Only property and only cost model is permitted for subsequent disclosure. Also, property 3 shall be presented as a separate line item as investment property. Are we okay with this?
Yes, yes, absolutely.
Yes, exactly what we thought about.
Yes,
Therefore, as per the provisions, the presentation is as under. So, property 1, property 2, investment properties. Yes.
yes. And any revaluation to be taken to revaluation surplus.
Yes, 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 yes. All right, next. All right, so that takes care of property 1 and 2 and 3. So this question is done, right?
Yes,
Yes, all
yes.
right. Now, next. Okay. On 1st January, Sun was notified that a customer was taking legal action against the company for financial losses incurred by the customer. Customer alleged that the financial losses were caused due to supply of faulty products on 30th September 20x1 by the company. Sun defended the case but considered based on the progress of the case up to 31st March 20x2, there was a 75% probability that they would have to pay damages of 10 lakhs to the customer. However, accountant of Sun Limited has not recorded this transaction as the case is not yet finally settled. The case was ultimately settled against the company, resulting in payment of 12 lakhs to the customer on 15th May 20x2. The financials have been authorized by the board of directors in its meeting held on 18th May 20x2. Analyze whether above accounting treatment is in compliance with Ind AS. If not, advise the correct treatment along with workings for the same. Yes? Done. Tell me.
Yes. A provision should be made.
Provision should
The
be
probability
made.
is
Why?
75 probability is that they would have to pay that.
Probability is probable. Yes,
Yes,
there is a probability that this will come and sit at our feet. So we will have to make a provision. Yes or no?
yes,
Okay, so this is true. After the narrative, these are accountant has not recognized the provision and hence not adjusted amounts in its financial statements. Potential payment to a customer is an obligation of out of a past event which can be reliably estimated. Therefore, following provision of Ind AS 37, a provision is required. Provision could be for best estimate of the expenditure required to settle the obligation at 31st March 20x2, which comes to 7.5 lakhs. Are we okay with this?
yes,
Yes. Further, following principles of Ind AS 10, evidence of the settlement amount in an adjusting event, therefore amount of provision created to 12 lakhs and shall be booked as a current liability. Are we okay with this?
Yes.
Yes. So that takes
Yes.
care of 2. Next. Number 3. Read number 3 and think. Done?
Yes, is done.
So what it is, you have a company engaged in farming. Government received a grant of 10 lakhs for engaging in plantation of eucalyptus. Eucalyptus are not considered as a bearer plant in this case. What do you mean by a bearer plant? Bear,
Uh, which bears the fruits.
fruits होता है. तो is bearer plant covered under Ind AS 41 or Ind AS 16?
India 16.
Ind AS 16. So this particular eucalyptus tree is not a bearer plant. Management has a reasonable assurance that the entity will comply with condition of engaging in plantation of eucalyptus trees for 5 years. And accordingly, it recognizes the proportionate grant for 2 lakhs in the P&L following principles laid down under Ind AS 20. Is the treatment correct? If not, give the correct treatment. Yes. What do you think? Yeah. See, as per the given facts, company engaged in farming, so Ind AS 41 is applicable. So you will then examine Ind AS 20. Ind AS 20 says that the standard does not deal with any grant covered under Ind AS 41. Yes or no? So therefore,
Yes.
what they have done is I have gotten a grant to plant for 5 years. So 1 साल हो गया, they took 2 lakhs in the income. Second year, another 2 lakhs. They wanted to do it like that. That is under Ind AS 20. But Ind AS 20 is not applicable here. Why? Because Ind AS 41 is applicable. Why Ind AS 41 is applicable? It is into farming and eucalyptus trees are not bearer plants. Since Ind AS 41 is applicable, Ind AS 20 is not applicable. And in Ind AS 41, if a government grant related to a biological asset is measured at its fair value less cost to sell is conditional, then you will not recognize the government grant in profit or loss until all the conditions are fulfilled. All the conditions are fulfilled. Now, all conditions will be fulfilled when? In first year or in fifth year?
Yeah, fifth year.
So therefore, until then, you will treat it as non-current liability and recognize it as income only in the fifth year after you meet all the conditions. After fifth year. Are you okay with this?
Yes, yes.
Yes. So fairly
Got it
simple.
now. Yes.
Yeah. So that is okay. Number 3, 2 is also done. Okay. You can do question 5 for homework. This is largely what we have already done. Yes. Okay. Next. Mercury Limited has sold goods to Mars at a consideration of 10 lakhs. Receipt of which is receivable in 3 installments of 3,33,333 over a 2-year period. Receipts on 1st April and 31st March X2 and 31st March X3. Company is offering a discount of 5%, that is 50,000 if payment is made in full at the time of sale. The sale agreement reflects an implicit interest rate of 5.36% per annum. Total consideration to be received from such sale is at 10 lakhs and hence management has recognized the revenue from sale of goods for 10 lakhs. Is this treatment in line with Ind AS or not? If not, please advise the correct treatment. What do you think?
Yeah, the revenue should be spread over the period of 3 years.
Over the period of 3 years, not only that,
The interest component is also to be recognized.
Absolutely. You will have to factor in the interest component also. Okay. Why? Because this is having a significant financing component where you are receiving the consideration after 3 years, over 3 years, right?
Yes, yes.
So that revenue from sale of goods shall be recognized at the fair value of consideration received or receivable. Fair value determined by discounting all future receipts using an imputed rate of interest where the receipt is deferred beyond normal credit terms. The difference is recognized as interest revenue. The fair value of consideration of the sale of goods is as under. You have 3,33,000 each year that you are collecting. Yes. First year you are collecting immediately, then at the end of year 1 and then at the end of year. Are we okay with this?
Yes.
Yes. So 9,50,000 is your consideration value. So what entry you will pass is first time when you recognize sale, cash account debit the first installment 3,33,000 to sale 9,50,000. Balance is your trade receivable. Are you okay with this?
Yes, yes.
Next,
Done.
cash account debit 3,33,000 to interest income to trade receivable 3,280,000. Yes.
Yes.
And last one, repayment of interest and final installment, cash to interest income to trade receivable. And that closes out the trade receivable, interest income, everything. Are we okay with this?
Yes.
Okay. So now if I look at the P&L extracts, sale of goods, 9,50,000, March, nothing. Other income 33,053 and 16,947, which is basically these two. Okay. Yes.
Yes, yes.
And trade receivables, you are given the amount. Is it okay?
Yes.
So that takes care of. Next. 5 given to you for homework. 6 we have already done. Him limited. You remember this question? Yes. Last class. Having net worth about to adopt. The senior manager has identified 6 issues. You remember this question?
Yes, yes. Now remember.
So
Yes.
this is already done. Covered under Ind AS 101. Okay. So from my side, I have given you 2 questions for homework. Question number 5 here and there illustration number 7. Yes.
Yes, yes.
All right. So that kind of, this is a broad overview of how the things are in terms of Ind AS. Okay. Because now at this stage, what is important to know is that you are knowing the standards, but knowing the standards should be accompanied with an analytical mind. Just knowing the standards, say, we are not going to get any output. We need to be able to understand how to analyze the financial statements. Okay. So that's what, as I said in the beginning of today's class, many times Ind AS adjustments are only, what do we call it? Temporary, so to speak. When I say temporary, I don't mean that Ind AS will be discontinued after some time. What I mean to say is, as and when the particular instrument or the particular arrangement reaches its end, automatically it will move back to the original position that would have been the case if gap would have been followed. If gap would have been followed. Yes or no?
Yes.
So ultimately, the whole objective is that I want to, within my books, I want to create separate accounts that track the Ind AS movements, and I will maintain separate accounts uh, that track my movements in terms of business or in terms of managerial requirements. Management will not generally be interested in the Ind AS analysis. Okay. I've discussed the reasons also. Okay. Now, when you look at your Schedule 3 to the Companies Act, I want you to go through this schedule also for homework. This is already just a pullout from the MCA website. Institute also has put in this annexure or whatever it is to the financials. Okay, so this
Okay.
one you will have to go through. Okay, rounding off norms are given. You may not remember anything for the purposes of financial reporting, but what is important is tomorrow when issues come up, you will have this as a ready reckoner for your preparation and understanding. Okay, next. So you are having part 1 of the balance sheet, which gives you the template. Then you have part 2, that is, so after the balance sheet, you have statement of changes in equity. After statement of changes in equity, you will be having uh, statement of changes in balance sheet. You will be having statement of changes in equity. You will be having the P&L, right? After that, and the cash flow statement. So these are the 4 statements that you will be required to prepare. Yes, at every point of time in terms of your reporting. Okay. Second. Yeah. Yeah. So the P&L. And always remember the P&L template that is given here. This P&L template, you can introduce subtotals, you can introduce some line, you can delete some line if it is giving better understanding. If it is giving better understanding. For example, for one of the companies which traded in plots of land, right? So what they would do was they would purchase land. They would then work on subdividing the land into plots. And after subdividing the land into plots, they would then sell one plot to the customers. Okay, so this was the activity. Plotted development, they call it. Okay, so what used to happen was they would recognize the purchase of land as inventory. Obviously, it is inventory. They would recognize the land as all the expenses incurred, like municipal fees, charges to the government for subdivision, charges for giving survey numbers to each of those, plot numbers to each of those individual plots which form part of the survey. All these direct costs were already included in that particular plotted development, and it was allocated to each of the plot of land. Okay, now when suppose you had 100 plots, out of 100, 25 plots were sold, 75 plots were there in inventory. So now what they used to present was they would present sale of plots as income, which is correct. They would present uh, purchase of plots also in the P&L, purchase of plots as a single item, and then they would present change in opening and closing inventory. That is the difference between closing inventory of plots of land and opening inventory of plot of land. Are you okay with this?
Yes, sir.
Yes. Now, understand from the perspective of a reader of financial statements. If he has to look, acha, this is my plot sale, and then if he wants to see what is the direct cost of selling those plots, do you think this data will be helpful? Revenue, cost of material consumed, purchase of stock in trade. Do you think this will be better? Or do you think that opening plus purchase minus closing, so that gives you cost of plots sold? Would that be better? Sale minus cost of plots sold to give you gross profit. Which one would be better? Instead of sale,
Yeah, including purchases.
minus purchase minus change in inventory. Instead of this, which would be better? Sale minus cost of plots sold. From an analytical perspective, which looks better?
Second one, sale minus
Second
cost
one.
of.
But sir, this is not given in the P&L that we can show. You can show. Okay, the whole point is you can still show it separately. Okay, you can still show it separately. Are we able to understand?
Yes, sir.
Yes.
Yes.
So you can introduce totals, subtotals, anything that can help make your financials more clear to the user. Okay, that will provide more information to the user. Okay, so that is what is important for the preparation of financial statements. Okay, next, nothing. Okay, so as far as consolidation is concerned, same templates again for balance sheet P&L. Only one thing you will have to disclose in the end is an additional information, that is basically a name of the entity. What is the net assets, that is total assets minus total liability, share in P&L, share in after comprehensive income. Are we okay with this?
Yes, sir.
Yes. So this is one thing that is a requirement of the regulator. Okay. So with the others, yeah, I think we are more or less covered. Okay. All right. Fine. There are many cases where inconsistencies will be observed. Currently, we are working on one of the inconsistencies, that is determination of profits for managerial remuneration and CSR, right? Now, if you look at determination of profits for managerial remuneration, how do? You start with the profit figure, you take some credits which are allowed, you ignore some credits which are not allowed, and then you arrive at the profits for the purposes of managerial remuneration. Yes or no?
Yes, yes.
This was taken from section 349 of 1956. That same thing has been cut, copy, pasted as 197 or 198 of Companies Act 2013. Yes?
Yes, yes.
Problem arises with Ind AS adjustments. There is no clear-cut guidance, neither from the Ministry of Corporate Affairs nor even the Secretarial Institute has given any interpretative guidance on how do we do a harmonious interpretation between Companies Act and Ind AS financials. Okay. For example, I have subscribed to preference shares of a company. They are, suppose I gave preference shares to my subsidiary at a very low interest dividend rate, 0.01%. Okay, I have given them preference shares at 0.01% discretionary dividend, but this is mandatorily redeemable. Okay, mandatorily redeemable. You cannot convert. Tell me one thing. 0.01% discretionary dividend, is it at fair value or not at fair value?
Not at fair value.
Not at fair. So you have to bring it at fair value. So when you
Yes.
bring it to fair value, the differential will go and sit in equity component. Yes or no?
Yes, sir.
And we also know that whatever sits in equity component remains there permanently. Yes.
Yes.
Now, the problem that arises is every year we do an unwinding of discount. Yes.
Yes, we do.
The question is that unwinding of discount, what is its nature? Is it in terms of 198 clause 3 clause E? Is it something related to fair value measurement, impact of which is going to equity and hence needs to be excluded? Or in terms of 198 3F, is it a notional item that is to be excluded for the purposes of CSR computation? I mean, for the purposes of managerial remuneration for CSR or managerial remuneration calculation of profits. What is the position? Unfortunately, there is no position. There is no interpretative guidance. We will end up doing the things in the best possible manner. Yes, and we will have a supporting. But the point is this: you will have analytical issues cropping up every point of time for Ind AS. Ind AS is not going to be an accepted norm for managerial utilization. Okay, managers will still prefer their MISs in the same way that they are used to, and they will always say what you do for Ind AS is not having anything to do with business. And in some cases, they are right also. I cannot deny that. Okay, so that our role is to ensure that we give a meaningful analysis to the management, or when we are the management, we obtain useful information. And later on, thereafter, what it will be is after uh, obtaining meaningful information, communicating, then you will also have to ensure that you prepare in compliance with Ind AS. You prepare the financials in compliance with Ind AS. Are you able to understand?
Yes,
Yes.
yes. Yes.
And finally, for your own understanding, you will have to prepare a reconciliation between those two. It is only when you kind of work on these areas repeatedly, then you can say that your analysis of financial statements, you are getting more and more the hang of it. Okay. So, this is more like a summary chapter of what you have already studied for so long. Okay, so in that terms, yeah, the chapter per se is over, but remember that these are some of the finer points that we have already discussed. You have any questions, Sanjay?
No, it's okay. clear everything.
नहीं ओके मतलब कोई डाउट है तो वो
No,
पूछ
no, no, no.
सकते हो.
Clear, it's clear. No
Clear?
doubt.
Okay, fine.
Yes.
So go through these two questions. We can definitely discuss if you have any other issue on Saturday. Okay. So that's it from my side. Thanks everyone. Thank you.
Thank you very much. Thank
Thank
you.
you.
Thanks a lot. It is a
Session
privilege
concluded.
of learning from you.
Yes. Yes, yes. Session conclude करें? Yes,
Yes.
yes, yes. Thanks. Thank you.